All right, ready to dive deep. We're taking a close look at Bank of America's 2023 annual report.
Sounds good.
So you're probably wondering, how do they do, right? Where do they stand now? What about the future? What's coming next? Well, we've got a ton of information here. Financials, insights from leadership.
Right.
We even get a little peek into their sustainability efforts, employee programs, all sorts of stuff. Get ready for some, maybe some surprising stats.
Yeah.
And by the end, we'll have a super clear picture of this financial giant,
Yeah, it's interesting how they're framing things. This responsible growth theme.
Right.
They keep coming back to it, right? It seems like they're trying to find this balance, acknowledging that the global landscape is, well, a little shaky, but still, projecting confidence and stability.
Yeah, it's like they're saying, hey, we see the same choppy waters as everyone else, but we've been around since 1784.
Right.
We've seen elections, geopolitical, whatever you call it, you name it. But then they also mentioned that consumers and businesses are being a bit cautious.
Yeah.
Because of, all this global uncertainty.
Yeah.
So do they really think they're, immune to all of that?
Well, they definitely acknowledge it as a potential headwind, you know. But remember, they did return $12 billion to shareholders.
Oh, right.
And they increased their dividend by 7%.
Yeah.
I mean, those are actions, right? Those speak louder than words. It signals confidence to investors, for sure.
Okay, yeah. Confidence noted. But let's talk digital for a second.
Okay.
They're boasting about, 3.3 billion digital logins.
Wow.
That's a 10% jump, crazy.
Right.
And almost half of their consumer sales are digital now. And their business banking platform, CashPro,
Right.
75% client engagement. Are they, becoming the Amazon of banking or what?
Those are some impressive numbers, no doubt about it. But it does make you wonder, right? Is this all organic growth?
Yeah.
Or are they kind of nudging, maybe even pushing their clients towards digital just to cut costs?
Oh, interesting.
Think about it. Like when the airlines started charging for checked bags, that wasn't really about giving people choice, was it?
Oh, yeah, good point. So their digital push could be about, streamlining their operations and ultimately their bottom line.
Yeah.
Speaking of investments, they're really pouring resources into their workforce.
Right.
They're bragging about an 87% employee engagement score. That's up 2% from last year.
Yeah, and it's not just talk.
Yeah.
They're raising their minimum wage to $23 an hour. And get this, aiming for $25 by 2025.
Wow.
Plus, over $4.8 billion went out in sharing success compensation awards. They really seem to understand that happy, well-compensated employees are key.
Yeah. Yeah, absolutely. It's a big bet on their people.
It is.
And then there's this whole social impact push. $1.5 trillion committed to sustainable finance, with a chunk of that, going towards building a lower carbon economy. Feels like every company's jumping on that bandwagon these days.
It's definitely a trend, but Bank of America seems to be going beyond just the environmental stuff.
Okay.
They're also supporting women entrepreneurs with dedicated platforms and specific initiatives.
Oh, right.
Did you see the Bank of America Institute for Women's Entrepreneurship at Cornell?
Oh, yeah. I read about that.
And remember that $20 million commitment to fight anti-Semitism through that FCAS thing?
Yeah.
They're even encouraging employees to wear those blue square pins, like a visible symbol of their stance,
It's almost like they're trying to be the good guy.
Right.
In the financial world, but actions speak louder than words, right?
Absolutely. It's easy to make big pronouncements in an annual report.
Right.
The real test is, do they actually deliver, and how do they measure their impact?
Right. Good point. Okay, so they're painting this picture of a bank that's, not just about profits, but also people and the planet. But how are they actually managing risk and staying transparent in this, crazy financial world we live in?
Well, they talk about their risk management framework.
Yep.
They mention stress tests, contingency planning, for economic shocks, all that kind of stuff.
Yeah.
Which, any smart investor would want to see. And they acknowledge climate risk.
Yeah.
Aiming for net zero emissions by 2050. They've even got these 2030 targets for key sectors. And they break it all down, loan portfolios, credit risk concentrations, even how they approach cybersecurity threats.
That's a lot of detail.
It is.
But it seems like they're trying to be transparent.
Right.
At least, on paper. But remember, this is just their version of the story.
Exactly.
We need to kind of compare it to, other analyses and maybe even some contrasting viewpoints to really get the full picture.
Right. Don't take anything at face value.
Yeah. Okay, so let's get into the nitty-gritty. Their
Okay.
financial performance. Let's see if those numbers match their ambitious goals, right?
Right.
So starting with the basics. They reported revenue, net of interest expense, of $98.581 billion in 2023. That's up from $94.95 billion in 2022.
Okay.
And $89.113 billion in 2021. So revenue is clearly trending upwards. That's a good sign, right?
Yeah, positive growth for sure.
Yeah.
But, it's not the whole story.
Okay.
Their net income for 2023 was $26.515 billion, or $3.008 per diluted share. And that's actually down slightly from $27.528 billion in 2022. So what do you think caused that dip?
Well, they're blaming it on higher non-interest expenses.
Okay.
And a bigger provision for credit losses. Basically, they're setting aside more money to cover potential bad loans.
Makes sense.
But it's not all doom and gloom, though.
Yeah.
They're also highlighting higher net interest income, which kind of helped offset some of those losses.
Right. And remember, higher interest rates are a double-edged sword.
Yeah.
They can boost a bank's income,
Right.
but they can also hurt borrowers who, are struggling to make their payments. They're walking a tightrope here for sure.
Yeah, definitely. It's also worth noting that their return on average assets was 0.84% in 2023.
Okay.
Basically, this shows how efficiently they're using their assets to generate profit.
Yeah.
It dipped slightly from 0.88% in 2022, but it's still, respectable in the current, economic climate.
Right.
Investors will be watching to see if that number climbs back up. What about the dividend, though? I mean, that's what a lot of investors really care about, right?
Absolutely. And they didn't disappoint. Bank of America paid out 92 cents per common share in 2023.
Okay.
Up from 86 in 2022. Those consistent dividend increases, that's a strong signal to investors.
Wow.
It shows they're confident about their future earnings potential.
Yeah, they're definitely trying to keep their shareholders happy. The report also mentions returning a whopping $12 billion to shareholders in 2023
Wow.
through dividends and share buybacks. That's a massive chunk of change.
Yeah, share buybacks are interesting.
Yeah.
By reducing the number of outstanding shares, they can potentially boost earnings per share,
Okay.
making existing shares more valuable.
Right.
It's like shrinking the pie so that each slice gets bigger.
Clever. Okay, so they're generating revenue, managing risk, rewarding shareholders, all that good stuff. But what about their loan portfolio?
Yeah.
That's a big part of what banks do, right?
At the end of 2023, their average loans and leases totaled, I get this, $1.014 trillion. That's a significant increase from the previous year.
Wow.
This shows they're, actively lending, which of course fuels economic growth, but we should probably take a closer look at the types of loans they're making.
Yeah.
To really understand their risk exposure.
They break down their loan portfolio by industry.
Right.
For example, capital goods lending is their third largest area,
Okay.
$97 billion committed, an 11% jump from last year.
Hmm.
That aligns with their strategy of, supporting business growth.
Right.
But it also exposes them to risk if those industries struggle.
It's a calculated risk. They're also lending to train companies, distributors,
Right.
machinery companies, industrial conglomerates, you name it. This diversification helps to kind of spread the risk, right? But they are keeping a close eye on how global events, geopolitical tensions, inflation, rising interest rates, all of that might impact different industries.
So it's like a giant game of chess, right? Trying to anticipate and mitigate those risks.
Yeah.
While also capitalizing on, opportunities.
Exactly. And that's where their risk management framework comes in.
Right.
They really emphasize their proactive approach to dealing with, potential economic shocks, credit risks, all that stuff.
They even have a financial contingency and recovery plan, which sounds pretty serious.
It is.
What's that all about?
It outlines the steps they would take, to boost capital liquidity if things went south. Things like accessing funding sources, selling assets, maybe even selling off entire parts of the business. It's their safety net.
Wow.
In case of a major economic downturn.
Yeah. It's good to know they have a plan. They also mentioned a resolution plan.
Right.
To, minimize the damage to the wider financial system if they ever faced, like, a collapse. And it's good to see they're, thinking about the bigger picture.
Yeah.
Speaking of the big picture, let's talk about their massive digital transformation.
Okay.
Remember those 3.3 billion digital logins we talked about?
Yeah.
It's pretty clear that people are, embracing digital banking.
Right.
They're comfortable managing their finances online through mobile apps, all of that.
Yeah.
Bank of America is riding that wave,
Yeah.
Reaching more customers, cutting costs, and gathering valuable data on customer behavior.
It's a win-win, at least on the surface. Yeah.
They also highlight their Cash Pro platform, which is their digital hub for business banking. They say 75% of their commercial clients are using it.
Wow.
And they're constantly adding new features, like integrating their virtual assistant, Erica.
Oh, right. Erica.
She's getting around.
Yeah, she is.
It shows they're committed to using AI to personalize those services for businesses.
Interesting.
And they even have a Cash Pro app now,
Oh, wow.
which lets clients manage their accounts and access financial services on the go.
Mm-hmm.
It's all about convenience and meeting customer needs in this digital world.
Yeah, for sure. And they're not forgetting about, their commitment to sustainability,
Right.
even when it comes to employee benefits.
Yeah, they've got this global electric vehicle program
Oh, yeah.
offering reimbursements of up to $4,000 for new electric vehicles or $2,000 for leases.
Mm-hmm.
To eligible employees, of course.
That's a pretty sweet perk.
It is. It shows they're serious about walking the walk when it comes to environmental responsibility.
It's also a smart move for attracting and retaining talent,
No?
especially, folks who care about sustainability.
Yeah, definitely appealing to that environmentally conscious crowd.
It is.
But let's not forget about all those other efforts they're making to, keep employees happy. They're really making a big deal about their commitment to attracting and retaining top talent, and they're backing it up with some serious investments.
Yeah, it's not just about fluffy perks.
Right.
They're pouring resources into talent development, with programs like the Academy at Bank of America.
Mm-hmm.
They're offering tuition assistance, fostering a culture of employee engagement.
Right.
All of that. It all adds up to a more motivated and productive workforce, which, of course, benefits their bottom line in the end.
Yeah, for sure. They're really proud of that 87% employee engagement score.
All right.
And let's be honest, nobody's engaged if they're not, getting paid fairly. So they bumped up their minimum wage to $23, aiming for $25 by 2025.
Wow.
Plus, they gave out over $4.8 billion in sharing success compensation awards.
That's a significant investment in their people.
It is.
They're trying to be a leader in the industry, when it comes to compensation and benefits. And remember, a happy employee is often a loyal employee.
Right.
Which means lower turnover costs for the bank.
It's all connected.
Oh.
Okay, let's shift gears for a second and delve into those social impact initiatives we were talking about earlier.
Okay.
They're really pushing this $1.5 trillion sustainable finance commitment, with $1 trillion specifically aimed at that shift to a low-carbon economy.
Mm-hmm.
Are they truly becoming a green giant?
Right.
Or is this just, greenwashing?
Well, they're definitely putting their money where their mouth is, at least to some extent.
Okay.
They're allocating capital to clean energy sectors, developing financial solutions for the low-carbon economy, and working with clients to reduce their environmental impact.
They're even setting measurable targets for reducing financed emissions.
Right.
In key sectors like auto manufacturing, aviation, cement, energy, power generation, the whole works.
Yeah, that's a good sign. It shows they're not just making vague promises. They're setting concrete goals.
Right.
And holding themselves accountable.
Yeah. It's definitely a step in the right direction.
Yeah.
But, we'll have to track their progress over time.
We will.
To see if they actually deliver.
Absolutely. And let's not forget about their other social initiatives, right?
Right.
Remember their support for women entrepreneurs.
Oh, yeah.
They're connecting women-owned businesses with funding opportunities through their Access to Capital directory.
Uh-huh.
And they're even showcasing their products and services through the Bank of America Marketplace by Seneca Women.
It's great to see them, championing diversity and inclusion in the business world.
It is.
And then there's that multi-year $20 million commitment to the Foundation to Combat Anti-Semitism.
Right.
They're even encouraging employees to wear those blue square pins as a visible symbol of support.
It's a bold move, taking a public stand against discrimination, promoting tolerance.
Yeah, definitely sends a message. Okay, we've covered a lot of ground, but let's not forget about the bottom line.
Right.
What do their profitability metrics look like?
Well, they reported a return on average common equity of 9.75% in 2023. That's it's a key measure of how effectively they're using shareholder investments to generate profits.
Okay.
It's down slightly from 10.75% in 2022.
Right.
But still a decent return considering, the current economic climate.
So they're making money for their shareholders.
Yeah.
But what are the key drivers behind those profits?
Well, net interest income is a big factor. They earned $53.2 billion in net interest income in 2023.
Okay.
That's a big jump from $37.8 billion in 2022. This is largely due to higher interest rates and loan growth.
So they're, riding the wave of those rising interest rates.
They are.
Which is good for their bottom line, but, potentially bad news for borrowers who now have to pay more interest on their loans.
Exactly. It's a balancing act. They also generate significant revenue from non-interest income.
Okay.
Things like, fees and commissions from investment banking, wealth management, card services, all that.
But their non-interest income actually dipped a bit in 2023, right?
It did.
Dropping to $45.4 billion from $47.2 billion in 2022.
Right.
What do they say about that?
They're blaming it on lower investment banking fees and market volatility.
Oh, right.
Those areas are more sensitive to those economic fluctuations, but they're trying to diversify their offerings, expand into new markets to kind of offset those risks.
Okay, makes sense.
Yeah.
Now, what about efficiency? Their efficiency ratio came in at 66.79% in 2023.
Right.
For those who aren't familiar, this ratio measures how well a bank is controlling its costs relative to its revenue.
Right.
Lower ratio means they're running a tighter ship.
It does.
So how does their 2023 number look?
Well, it's up from 64.71% in 2022.
Okay.
Suggesting that their expenses are, creeping up a little bit.
Oh.
But remember, they are making those strategic investments, right, in digital transformation, talent development.
Right.
All of that can push costs up in the short term.
Yeah. It's a trade-off, I guess.
It is.
They're betting that these investments will pay off in the long run, through greater efficiency,
right,
improved customer service, and ultimately higher revenue.
Exactly. It's a long-term vision. Now, let's talk about their capital position,
right,
which is essentially a measure of their financial strength,
right,
and their ability to weather a storm, so to speak.
Give us the financial health checkup.
All right. Their Common Equity Tier 1, or CET1, capital ratio stood at 11.8% at the end of 2023.
Okay.
Think of this ratio like a bank's safety cushion.
Got it.
It represents the core capital they hold compared to their risk-weighted assets.
So the higher the ratio, the better.
Exactly.
Okay.
A higher CET1 ratio means they're better equipped to absorb potential losses.
Right.
And their 11.8% ratio exceeds regulatory requirements, which is a good sign.
Yeah.
It means they have that buffer to protect against any unexpected losses.
Good to know. They also mentioned their CET1 capital growing by 8% year over year, reaching $195 billion by the end of 2023.
That's a healthy increase, driven by strong earnings and their commitment to maintaining a solid capital base.
Yeah.
And they're also prepared for any changes to capital rules, like the proposed Basel III Endgame.
Oh, right.
Those international banking regulations aimed at strengthening capital requirements.
So they're saying, bring it on, we're ready.
Pretty much.
Yeah.
It's reassuring to see that they're taking these steps to, ensure their financial resilience, especially with all the uncertainty in the global economy.
Yeah, absolutely. A strong capital position is essential for any bank.
It is.
Allows them to continue lending, investing, pursuing their growth strategy, all that.
Right.
And it gives investors and customers confidence that they can weather any storms that come their way.
Absolutely.
Okay, so they're, financially sound, digitally savvy, and committed to sustainability and social impact.
Yeah.
But what about their efforts to, combat discrimination, promote diversity and inclusion? That's
it's a hot button issue these days.
It is.
Yeah, it's a critical area for any company, and Bank of America seems to be taking it seriously.
Okay, good.
They're highlighting their long-standing commitment to diversity and inclusion, including their work to combat, hate and discrimination directed at any group.
They're not shying away from tough topics.
They're not. They're addressing anti-Semitism, homophobia, Islamophobia, racism, sexism, xenophobia, discrimination based on race, nationality, ethnicity, religion, sex, gender identity, sexual orientation, age, disability, veteran status, you name it. It's a pretty comprehensive list.
It is. It is. So they're taking a broad-based approach.
Yeah, they're not just focusing on internal policies and practices,
right,
but also partnering with organizations to promote diversity and inclusion in the wider community.
Like their partnership with the Foundation to Combat Anti-Semitism.
Exactly. They're supporting that FCAS's Blue Square campaign, encouraging employees to wear those pins, show their commitment to combating anti-Semitism, and they've pledged $20 million to support FCAS's efforts.
That's that's a significant financial commitment.
Mm-hmm.
And a powerful message of solidarity.
It is.
Which is they're putting their money where your mouth is.
Right.
When it comes to, fighting discrimination. They're also tracking their internal diversity metrics.
They are?
They report that their board diversity is 62% diverse with 38% women.
Okay.
And they break down the diversity of their workforce by race, ethnicity, and gender. So, for example, women make up 32% of their senior management team and 39% of their mid-level management team.
Yeah.
And they're, highlighting the percentage of people of color in different management levels.
Those statistics are important, for transparency and accountability.
Yeah.
They show where they stand in terms of representation.
Right.
And they can use this data to track their progress over time.
They're also committed to pay equity.
Good.
And they're making efforts to recruit talent from diverse backgrounds through, targeted campus recruiting programs.
These are all positive steps.
They are.
Creating a more diverse and inclusive workplace is not just, the right thing to do. It's also good for business.
Right. It brings in fresh perspectives and ideas and helps them connect with a wider range of customers.
Exactly.
Okay, we've covered a lot of ground here. Let's move on to their risk management practices.
Okay.
A topic that's probably on a lot of investors' minds.
Absolutely. They dedicate a significant portion of the report to outlining their risk management framework. It's a comprehensive system designed to, identify, assess, and mitigate potential risks across all areas of their business.
They emphasize their proactive approach.
They do.
Anticipating potential threats and taking steps to, prevent or minimize their impact.
Right.
They also highlight the importance of risk culture, encouraging employees to be vigilant, report potential risks, all that.
They have a dedicated risk management team that works closely with business units to identify and assess those risks. They also have a robust system of controls and procedures to, mitigate those risks.
So they've got all their bases covered.
They're trying to. And their risk management framework is regularly reviewed by senior management and the board of directors.
They also conduct stress tests to see how they would fare in various adverse economic scenarios, like a severe recession or a financial market crisis.
Exactly.
And they have a well-defined process for managing credit risk, assessing the creditworthiness of borrowers, setting credit limits, monitoring loan performance.
They're also actively managing market risk.
Okay.
Which stems from, fluctuations in interest rates, foreign exchange rates, commodity prices, all of that.
So how do they manage that?
They use hedging strategies to mitigate those risks.
Okay.
Hedging involves taking offsetting positions in financial instruments to reduce the impact of those, price swings.
Can you give us an example?
Sure. So, for example, they might use interest rate swaps to protect against changes in interest rates, or currency forwards to hedge against currency fluctuations.
Okay.
They also use options and futures contracts. And their hedging activities are subject to, strict risk limits and are closely monitored by their risk management team.
So they're not just throwing darts at a board here.
They're not.
They're using, sophisticated modeling techniques to measure and manage market risk. Okay, now let's move on to operational risk management.
Okay.
Operational risk is, about protecting themselves from things like fraud, cyber attacks, natural disasters, even human error.
All of that.
So do they have a framework in place for, identifying, assessing, and mitigating these risks?
They do. They have a dedicated team that monitors operational risk across the organization. They conduct regular risk assessments, implement controls to prevent or, minimize potential losses.
And what about, in case of a major disruption?
Well, they have a robust business continuity plan to keep things running smoothly.
Okay.
And they're investing heavily in cybersecurity to protect their systems and data from cyber attacks.
Yeah, essential steps in today's world.
Absolutely.
And what about compliance risk?
Right. Compliance risk is all about making sure they're following all the applicable laws and regulations. Yeah. And internal policies, of course. So, Hal, welcome back. We're continuing our journey through Bank of America's 2023 annual report. Remember, we're not just looking at the numbers.
Right.
But trying to understand, the strategy and values behind them.
Yeah, exactly. It's like reading between the lines.
It is.
To get that, full picture. So in the first part, we covered their responsible growth strategy.
Right.
Their digital transformation and their social impact initiatives.
Mm-hmm.
Now, I'm kind of curious to see how that commitment to responsible growth actually plays out.
Yeah.
And their financial performance.
Yeah.
Are they sacrificing profits for the sake of, sustainability and social good?
That's the million-dollar question, right? So let's look at those profitability metrics a little bit closer. We touched on their return on average common equity,
right,
which was 9.75% in 2023.
Right.
A slight dip from the previous year.
Uh-huh.
But remember, profitability isn't just about one number. It's about understanding what's driving it.
Okay, so break it down. What are those key drivers of your profitability?
Well, their net interest income is a major contributor.
Okay.
And it jumped significantly in 2023.
Okay.
Reaching $53.2 billion.
Wow.
Compared to $37.8 billion in 2022.
Okay.
That increase was largely driven by higher interest rates.
Okay.
And loan growth.
So are they basically, benefiting from the fact that everybody's paying more interest on their loans now?
To a certain extent, yes. But higher interest rates are a double-edged sword.
Right, of course.
While they, boost a bank's income, they can also put pressure on borrowers who are struggling to make those payments. Bank of America acknowledges this and emphasizes their focus on, responsible lending practices.
Yeah, it's a delicate balance.
It is.
Maximizing profits, but also making sure they're not squeezing those borrowers.
Exactly. And they also generate significant revenue from non-interest income, which includes, things like fees and commissions from investment banking, wealth management, card services, all of that.
But their non-interest income actually dipped a bit in 2023, right?
Yeah, it did, dropping to $45.4 billion from $47.2 billion in 2022.
Okay, so what do they say about that?
They attribute it to lower investment banking fees.
Okay.
And, market volatility.
Yeah, those areas can be, sensitive.
They can.
To economic fluctuations.
Right, to mitigate those risks. Yeah. They're diversifying their offerings, expanding into those new markets. They're also investing in technology to improve efficiency and customer experience.
Makes sense.
Which should ultimately boost both interest and non-interest income.
Right.
In the long run.
Okay, so they're navigating this, complex economic landscape. But their overall profitability seems pretty solid.
It does.
What about their efficiency, though? Are they running a tight ship?
Well, their efficiency ratio came in at 66.79% in 2023.
Okay.
Which, as you explained, measures how well they're controlling costs relative to their revenue.
Right.
And that's up from 64.71% in 2022.
Okay.
Indicating, some pressure on their expenses.
So are they getting, a little bloated?
Not necessarily. Remember, they are making those significant investments.
Right. Those investments.
In digital transformation, talent development,
all
of that can push costs up.
In the short term.
Right, exactly. It's a long-term game.
It is. But what about their financial stability?
Yeah.
Are they prepared for, any potential storms on the horizon?
That's where their capital position comes in. Their Common Equity Tier 1 or CET1.
Right.
Capital ratio stood at 11.8% at the end of 2023.
Okay.
Which, as we discussed, is a key measure of their financial strength.
Right. So they have a good cushion.
They do.
To absorb, potential losses.
Exactly. And their CET1 ratio exceeds regulatory requirements.
Okay.
Which is a good sign, right?
Yeah.
For investors, for customers, it means they have that buffer to protect against those unexpected losses.
They also mentioned their CET1 capital growing by 8% year over year,
Yes.
reaching $195 billion by the end of 2023.
That's a healthy increase,
Yep.
driven by strong earnings and their commitment to, maintaining that robust capital base.
Okay.
And they're also preparing for any upcoming changes
Right.
to capital rules, like that proposed Basel III endgame regulations.
Right. Those international banking regulations.
Yeah,
So they're saying, bring on those tougher regulations. We're ready.
pretty much.
Okay.
It's a sign of confidence,
Right.
preparedness.
All right. So let's switch gears a little bit
Okay.
and explore their commitment to human capital management.
Okay.
Which is essentially how they attract, develop, and retain their workforce.
Right.
And, they're making a big deal about being an employer of choice, touting their, commitment to diversity and inclusion, competitive compensation, opportunities for professional development.
Right.
But are they walking the walk?
Let's look at the specifics.
Okay.
They're investing heavily
Yeah.
in creating a diverse and inclusive workplace, not just through, policies,
Right.
but through initiatives
Yep.
like employee resource groups,
Okay.
mentorship programs, diversity training, all of that.
So they're trying to attract top talent
They are.
by offering those competitive compensation and benefits packages.
Right. Health insurance, retirement savings plans,
Right.
paid time off, all the good stuff.
Yeah.
And they're not just, throwing money at the problem.
Right.
They're offering genuine opportunities for, professional development and career advancement.
Okay.
Tuition assistance, leadership training programs,
That-
online learning resources.
It's like they're building an internal talent pipeline.
Exactly. And they're not forgetting about employee engagement. They conduct those regular surveys to get feedback,
Yeah.
identify those areas for improvement. They also have programs to recognize and reward employees
Yeah, it makes
for their
sense.
contributions, right?
Right.
Fostering that culture of appreciation.
It sounds like they're creating an environment
Yeah.
where employees actually, feel valued and empowered.
That's the goal. And remember, a motivated and engaged workforce is essential for any company's success.
Right.
Now let's shift gears again
Yep.
and explore their community impact initiatives.
Right. They talk a lot about giving back to the communities
They do
where
it.
they, where they operate.
Right.
But what does that actually look like,
And-
in practice?
Well, they have a long history of philanthropy and community involvement,
Okay.
supporting a wide range of causes.
Okay.
From education, affordable housing,
Yeah.
to economic development, health and human services.
So they've got a, dedicated community relations team
They do.
working with those local organizations
Right.
to identify and address needs.
Exactly. They also encourage employee volunteerism
Okay.
and have a matching gift program
Okay.
that matches employee donations to those, eligible nonprofits.
So they're encouraging their employees to, actually get involved in their communities.
Yeah, it's about fostering a culture of giving back.
Okay, so they're investing in their employees, supporting their communities, and generally, trying to be a responsible corporate citizen.
Right.
But let's be realistic.
Yeah.
No company is perfect, right?
Of course not.
What are some of those challenges they're facing?
Well, they acknowledge the challenging economic environment.
Yeah.
Things like inflation, rising interest rates, geopolitical uncertainty.
Right. All of that.
These factors can impact their profitability,
Wow.
loan performance,
Right.
overall growth prospects.
It sounds like they're walking a tightrope,
They are.
trying to balance, growth and profitability
Right.
with responsible lending practices
Yeah.
and social impact.
Exactly. And they also face competition
Oh, of course.
from both traditional and non-traditional financial institutions.
Right. Yeah.
That financial landscape is it's constantly evolving
Yeah.
with new players emerging, especially in the fintech space.
So they need to stay, agile and innovative
They do.
to remain competitive.
Absolutely. And let's not forget about the increasing regulatory scrutiny
Oh, right.
on banks, right?
Yeah.
Regulators are constantly implementing new rules and requirements,
Yeah.
which can be costly and, and complex to comply with.
It's like a constant game of catch-up.
It can be, and they also need to stay on top of, emerging risks.
Right.
Like cybersecurity threats, climate change.
Uh-huh.
All of that can have significant financial and reputational consequences.
So they're facing a whole array of challenges,
They are.
both internal and external.
Yes. But they seem to be, aware of these challenges.
Okay.
And they're taking steps to mitigate them.
Well, we'll have to wait and see
We will.
how they navigate those choppy waters in the coming years. But so far, their commitment to responsible growth seems to be more than just lip service.
It does?
They're making, tangible efforts to balance their financial performance with their social and environmental impact.
It's an ongoing journey.
Yeah, it is.
And we'll continue to track their progress. But for now, let's take a short break.
Okay.
And we'll be back in part 3 to wrap up our deep dive and explore what this all means for you.
This is good.
As an investor or a customer, stay tuned.
Welcome back for the final part of our deep dive into Bank of America's 2023 annual report. We've gone through their financials, their strategy, the risks they face, and their commitment to social impact. So now let's put it all together and see what it means for you.
Yeah, time to connect the dots.
Right, exactly. So far we've seen that Bank of America is trying to walk this line, this tightrope between, generating profits and also being this responsible corporate citizen, investing in digital talent and sustainability, while also managing risk and navigating, this complex economic environment. What does it all mean?
It seems like they're betting on a future where banks are more than just, financial institutions.
Right.
They're also expected to be these agents of positive change, addressing social and environmental challenges, while still delivering value to their stakeholders.
So it's not just about making money, it's about making a difference.
It's about finding that sweet spot where purpose and profit intersect.
Yeah.
And you see that reflected in their, emphasis on responsible growth. That seems to be the central theme of this whole report.
But is it just a fancy marketing slogan? Or are they really walking the walk?
Well, we've seen evidence that they're taking concrete steps in several areas. Take their $1.5 trillion commitment to sustainable finance, for example.
Right.
That's a significant move. They're directing capital towards clean energy, green buildings, other sustainable initiatives.
And they're not just, throwing money at the problem. They're setting measurable targets.
Right.
For reducing financed emissions.
Exactly.
In key sectors.
Which suggests they're serious about holding themselves accountable.
They're also making some pretty notable strides in promoting diversity and inclusion.
Yeah.
Both internally and in the communities they serve.
Right.
Like their partnership with the Foundation to combat anti-Semitism.
Right.
Their commitment to increasing representation
right.
in their workforce.
Those are just two examples.
And let's not forget about their investment in their employees.
Yep.
Bumping up wages, offering generous benefits, providing opportunities for, professional development and advancement.
Yeah. They clearly see their workforce as a key asset.
Yeah, absolutely. A happy and engaged workforce is essential for any company's success in the long run.
It is.
But, they're not neglecting their core business either.
Right.
They're actively managing risk, maintaining a strong capital position,
right.
navigating the complexities of, this rapidly evolving financial landscape.
It's a balancing act.
It is.
For sure. But they seem to be approaching it with a long-term vision, investing in areas that they believe will drive that sustainable growth and create value.
Yeah.
For all their stakeholders.
Okay, so they're checking a lot of boxes. But let's be honest, every company has its flaws.
Right.
What are some of the, potential red flags or areas where they could improve?
Well, their reliance on net interest income,
which is heavily influenced by interest rates, makes them, vulnerable to those economic fluctuations. If interest rates fall,
right,
their profitability could take a hit.
Well, that's a risk for any bank, though.
It is. And while they are making efforts to diversify their revenue streams, they still face some pretty stiff competition.
Right.
from both traditional and non-traditional financial institutions.
Yes, of course.
That fintech landscape is rapidly evolving.
Yeah.
And they need to stay agile to keep pace.
They can't rest on their laurels.
They can't. And they also need to be mindful of the, the increasing regulatory scrutiny on banks.
Oh, right. Yeah.
Complying with those, new rules and requirements can be costly and complex.
It's a constant challenge for any financial institution.
It is. And let's not forget about the reputational risks associated with, any large bank. They need to maintain high ethical standards.
And avoid, any scandals or controversies that could damage their brand.
It's a lot to juggle. So what's the bottom line here? Should you invest in Bank of America?
Right.
Bank with them? Or just, keep an eye on them?
Well, that's a decision that only you can make.
Right.
But hopefully this deep dive has given you the tools and insights to make an informed choice.
We've explored their strengths, their weaknesses, their opportunities, their challenges. Now it's up to you to, weigh the information and decide what resonates with you.
Here's what I would suggest. First, consider your own values and investment goals. Do Bank of America's initiatives align with, what you're looking for?
Right. If you're an investor, are you comfortable with their level of risk, their reliance on interest rates?
Yeah.
And if you're a customer, do their, products and services meet your needs?
Right.
Are you satisfied with their commitment to social and environmental responsibility?
And don't just rely on this annual report.
Right.
Dig deeper, read independent analyses.
Yeah. Yep.
Consider different viewpoints. That financial world is constantly changing. So it's crucial to, stay informed and make those decisions that align with your individual circumstances and priorities.
This deep dive is just a starting point.
Right.
Now it's time for you to, take the reins, explore further, and draw your own conclusions.
Exactly.
Thanks for joining us on this journey through Bank of America's 2023 annual report. We hope you found it, informative and thought-provoking.
Until next time, keep learning, keep questioning, and keep diving deep.